reliable cash flow streams and companies that have products or services that have some sort of competitive advantage in the marketplace. The next slide goes to Eric.
Perfect. Thank you so much, Ari. So from here, I'm basically going to be talking about two types of the most likely deal structures that you'll see. The first one basically being the leveraged buyout, and then the other second one, which I'll get into, is the equity sponsored buyout. So just going into the leveraged buyout, basically, again, it's right there in the name, leverage. It's highly leveraged, where the buyers will basically use a relatively small amount of their equity, and they basically rely on management equity and non-dilutive debt to kind of pay for the remainder of the buyout. It's engineered to maximize leverage of management's equity contribution, and most sellers are wary to finance a meaningful part of the structure, because basically they are the second or third lien position. So what happens is they kind of incur equity-like risk, so higher risk, but they get instead lower returns, where it's more like debt-like returns. But sellers can protect themselves by reducing their finance exposure. They can do due diligence, such as checking buyer's credit, their credit rating. They can receive a personal guarantee from the buyer, or they can, again, kind of limit the duration to a shorter duration, which again kind of reduces the amount of risk, kind of just like very much like a bond, I guess, in some ways. A leveraged buyout structure is, again, highly leveraged, and because of that, sometimes a company can fail with unforeseen losses or costs just going on behind the scenes that might not be visible right up front. A management team's performance after this transaction or after the buyout occurs is very crucial, obviously, for the longevity or this the business basically staying alive after that transaction occurs. And after the transaction occurs, again, the book basically outlines how cash generation is very key, obviously, for the success of the business. Usually when they structure deal terms to defer payments by using things like interest-only loans, negotiating preferred payment terms with vendors, or to speed up payments from customers. So basically, again, ways that they can kind of get an advantage when it comes to the repayment terms. Managers also, essentially in this case, they trade added deal risk for increased equity interest. They might use programs like 504 loans or small business loans, and managers basically obtain control of the business with committing very little of their own cash.
Hey, Eric, you're at 1 minute left.
Okay. So with the second type of buyout here, basically the equity sponsored buyout, instead of, again, using a lot of leverage, I guess they still kind of use leverage in some ways, but they partner with a private equity provider to complete a transfer. So they're using more conservative capital structures than a leverage buyout. But what the private equity firm will provide is basically expertise in financing transactions. They just, that's kind of their business. So they will also provide more additional management if it's needed. Stock interest comes in two forms. Management team is given certain stock interests and at the close, and additional stock awards if certain benchmarks are hit. And then the management team can also purchase equity at very attractive terms, which is also known as the NV ratio. The equity sponsor contributes 20 to 40% of the buyout cost, while managers contribute basically little to nothing. So again, it's basically like leveraging another partner in this case. But a strong equity sponsor might attract senior lenders to the deal, basically getting better access to certain capital sources or funds, which might entice lenders to loan more and at more attractive rates compared to leverage buyouts. You want me?
All right, so you did not get a chance to answer the questions. That's okay. Let's move on to the next group, please. Thank you.
I can try and share my screen for the PowerPoint, guys. Let me see if this works.
And for the last group, Ari weaved the questions in with his slide.
Yeah, there was one question about when a management buyout would be something along the lines of most ideal. And we covered some of the industry characteristics and company specific characteristics that would enhance the success of an MBO.
Great. Can you guys see the screen?
Yes.
Cool. Thank you. Before I get going, I know we're supposed to start on the stock gifts portion, but I just wanted to present this fact here. We're working on family transfers, and I thought this was very interesting. 10% to 20% of private businesses actually transfer from one generation to the next. So that success rate right there alone isn't very high. I thought the number would be much higher, but that's pretty low in my opinion. So with that, I have the pleasure of talking about the most common method of transfer, which is stock gifts. I think that's generally due to how simple and direct this can be. I say can be because the problem with stock gifts of these private shares is really the valuation aspect. I know in the book it referenced it as less mathematical and more kind of judgmental is how it was put. But it's basically gifting stock in the company, a membership interest, as I point out there. The owners are trying to reduce and possibly freeze an estate value. The donor also leverages the stock gifts in a few different aspects as far as once they gift these shares, they hope that they appreciate, but the appreciation happens outside of the estate. So they're taking advantage of getting that asset out as opposed to keeping it in their estate. The book also mentions leveraging the lifetime exclusions and also the annual gifting, and also the key role that a spouse can play in the gift splitting process, which can be a huge amount of money in the end of things if you're going through the gifting process properly. That's what I mentioned there by the double leveraging via gift splitting. The last thing I wanted to mention too on this slide is the lack of marketability for these shares, and that's kind of what causes the discounting of shares, as mentioned in the book. There's difficulty in finding a hypothetical buyer for these shares. As far as private annuities go, you basically transfer a stock in exchange for an unsecured promise to pay a fixed payment for life. I think one important thing to note here is that neither of these parties can be in the business of selling annuities. So it couldn't be an insurance company, something like that. Basically, these tax consequences associated with private annuities change, I think in 2006 is what the book was referencing. So that's something to be aware of. There's different forms of it. I mentioned the single and joint survivor options there on my slides. The main use is for short life expectancies, which, I mean, if we all knew when we were going to go, this product could be very good. But as you know, life expectancy is something that we do our best to judge based off family history and current health conditions. But again, that's something that we really don't know about. That's why I put consult with the appropriate professional to achieve the desired results. Mainly on the tax side of things, I think it's important in any of these gifting areas to lean on a knowledgeable tax expert. Let's see if there's anything there. Oh, and then my last point here, I just want to mention that these private annuities, it's not really the industry standard to use these anymore, but given the right inheritance planning, business succession, or asset protection scenario, this might be a good fit. And then I'm going to pass this on to Jeff Stein.
All right, well, yeah, to follow up on what Logan had just mentioned with all these strategies I'm going to be talking about in the next few slides, it is really important to get a professional business valuation. So as you can see here, when we're talking about self-canceling notes, among these other things, it really focuses a lot on getting a lot of leverage out of using it because of the valuation discount. So on the right, it kind of shows an example of that. And really what a skin is it's a regular installment note, but it is set for a period of time. And if the seller of the business dies before that period, then the buyer no longer owes any more money and the assets out of the seller's estate. So again, kind of what Logan was just mentioning, could be something good for somebody who maybe has some health problems, who might be looking to transfer a business to a family member and try to get that out in the best way possible. Maybe, of course, save some money in the process. But the key is is that there has to be some sort of premium attached to it. So it explains here in the example on the right-hand side that there's a higher dollar amount of the actual purchase price of the company than what is calculated at the 4 million. Or you could do a higher interest rate. So it's based on applicable federal rates. So if the long-term AFR rate's 3%, you might need to charge 5 or 6% in order for these to meet the standards, I guess, for what the IRS has. So go ahead and go to the next page. And so another very popular funding tool is a grantor retained annuity trust. Again, you can see that this is heavily based on valuation discounts. But in this particular case, when we're looking at Joe, who has a company appraised at 4 million, wants to give 45% of that 1.8 million to his daughter, he's actually going to be able to do that for $160,000. Okay, that's what it shows at the very bottom. So there's really a lot of leverage involved with that. One thing in my career that I've known with GRATs versus IDGITs, and there's always a battle going back and forth between the two of them, is because the higher the interest, the higher the applicable federal rates that's helping to use the discounting that's able to be used for something like a GRAT. When those rates are much higher, GRATs are a better tool to use than an IDGIT. IDGITs right now, the last 10 years have been the better tool to use because the AFR rates are really, really low. So it kind of gives them a little bit more bang for the buck. And I'll be talking about IDGITs here in a minute. So go ahead and go to the next page. So with family limited partnerships, and family limited partnerships have actually historically been a pretty good tool to use. A couple of the main things that you need to always keep aware of with a family limited partnership is that there really does need to be some level of business purpose for it. So transferring shares of a company, of course, there's a business that is a company that's being transferred. I've had some clients and known some attorneys who kind of get fancy. I knew I had a client once who had a big yacht down in the Bahamas and put in a family limited partnership, and they would rent it out like a couple months a year and claim it as an FLP, which was awfully risky. So there really needs to be some sort of business purpose for it. But of course, with a company, and it shows here, again, this is heavily leaning upon valuation discounts as really making it a good route to take. There are some advantages, of course, and disadvantages here. Probably the biggest disadvantage, well, there is an expense, there's no step up in basis, but also the way the IRS scrutinizes them, you really got to make sure you put these together properly. And there's also some of the creditor protection, because in the FLP, you've got a general partner and then the limited partners. So the general partner, the person who creates it, has the liability, but they also have total control of it. All right, which is also what gives those valuation discounts to the percentage that's being given to those limited partners who then have some liability protection. So go ahead and go to the next slide. And with IDGITs, one of my favorite things, leave it to the government to come up with a name called intentionally defective grantor trust, and trying to explain to a client you need to do something that's intentionally defective can be challenging. So the name IDGIT's kind of cute. So that's generally what I use. Now these, I've found are really, like I said, first of all, when interest rates are very low, these have a bigger bang for the buck because it's based on a sale to the trust. The reason it's intentionally defective is because the grantor is actually paying the taxes in the trust. And I've had clients who say, well, I don't want to pay the taxes on the trust. Like, that's not fair to me. I'm setting it up for somebody else. But it's actually a big feature of the trust, because when you're paying the taxes on that trust, it's a free gift, right? So the grantor is having that money that they're receiving. Maybe it's the money that they're generating from the trust itself based on the installment note. And they could use that money to help offset and pay for the taxes within the trust. And it doesn't count as a gift. So it's actually a good feature of these trusts. So it has an example here that you could certainly read through. I don't need to read through all that, and I really don't have the time to do that. But with the advantages for generation skipping, taxes planning, great tool for that. Life insurance can be purchased in it. It works very much like an ILIT. So if there's a $1 million note that's being paid back to the grantor, at that grantor's death, that the ILIT could then, or not the ILIT, but the life insurance purchased within the trust could pay off the grantor, right? So that's a big part of it. If it hits to the point that it's at the end of a 10-year term of the note, based on the new AFR rates, you could also write a new note. So it could just keep going on and on until finally the death of the grantor. You could also do an asset swap, because let's say the asset that was in there grew a lot okay? And there, you know, you've got the taxes that are, the beneficiary is eventually going to have to pay those taxes. Well, at some point, the grantor can use cash to buy out those shares that have the huge appreciation back in their estate. The cost basis, then the trust goes up to what it is with cash, whatever that purchase price was. And then when the grantor dies, the beneficiaries now get a step up in the basis of what the value is of the swap of the thing. So anyway, gets a little bit tricky with that, but it's a very common and big advantage of that. And of course, there's disadvantages. One of the big disadvantages is cost. I had a client when I lived in Northern California, and this wasn't in San Francisco, it was in Santa Rosa in Sonoma County, who did one of these, and it literally, it cost $80,000. So there's a big cost to do that. There's ongoing costs with management. You also need to make sure that the asset within the trust is generating enough income that it could pay for the expenses that are in the trust. It's got to pay for the note. It's got some other expenses in there. So it's got to have some proper planning. Just putting in a piece of real estate, commercial property that's really not generating any income, or maybe it's a lot of land, not a good asset to use in something like an IDGIT. So otherwise, I think I'm pretty much ending right on time. So I'm finished with that. So.
And then Chris, did you want to take that question, one of the questions from group one?
Yeah, so we went ahead with the second question. Why would a divorce cause a buy-sell action? The simple answer is the buy-sell agreement would have that. Divorce would be a triggering event per the buy-sell agreement. And then the second part of that is, doesn't that basically punish the co-owner getting the divorce?
There's 1 minute left.
Okay, thanks. Technically, yes, it does punish him, but you could also have in there that that partner could buy back in, you know, once he settles his divorce. And basically it's protecting the company itself and the other shareholders by not having to deal with that other partner's ex-spouse now. So those are the quick answers to that question.
All right, great. You guys have potential. 12 minutes. Good job. All right, let me share my screen. We're going to go through two cases. And so for ESOP, we are going to use the case that was written by Dr. Stay and Dr. Cruz. Some of you may have Dr. Stay's class before. She teaches the macroeconomics. So I'm going to quickly go through the case with you, and then we're going to do a quick calculation toward the end. So quick reference, I think one of you or two of you are writing ESOP related. This might be a good website to use. This is a ESOP association. Basically, they provided number of ESOPs companies out there. So as you can see, the number is based on 2016. There are approximately about 6,000 or so companies out there. The ones that which is host inside the 401k is called a KSOP, and there are approximately about 1,000 or so out there. The ESOP could be structured based upon S corporation and C corporation. So in a moment, we're going to talk next week when we talk about the section 1202, this will come in play quickly. But for the moment, from ESOP's perspective, the only difference here will be on the tax consequences when you establish that. So there are a couple of the industries that are, you can see that manufacturing is a huge percentage in terms of company who goes into ESOP. So does construction company. As a matter of fact, the largest ESOP company, I believe, is a grocery store, and then followed by construction company. So these are all the companies that are out there, but not every ESOP is equal. So let's walk through the example here. Okay, so this case study is specifically for section 1042, in terms of the stock sales. We are going to use a company, assuming it's a C corporation, okay, in this case. George is the owner, established the company 20 years ago with the cost basis $1.50, basically nothing, okay? And he knows that by now his company is worth $10 million, okay? So $10 million, keep that in mind. That is, we're going to do calculation in a little bit. So his cost basis is basically zero, but the worth is $10 million. And wanted to do the, enabled to do that, he has 100 outstanding shares. Now, because we're walking through a case study here, just to let you know, 100 shares is not realistic. $10 million worth is also not realistic. This is a case study put together by practitioners. So just to illustrate the point. The goal is trying to basically have 51% majority shares sell to the corporation and then remain about 49% right here. And then you can tell that there are some planning purposes here to hold on to the minority share. So keep in mind that we have very low cost basis and there's no dividends being paid out. So the way it works is we're going to walk through the charts that group one previously provided. But we're going to walk through it step by step so you have a good understanding of how it works. And at the end, we'll do the calculation of it. So the way it works is that they will sell shares. They will use the shares, right, to borrow money from the lender. Let's say it's $10 million. That's going to inject into the company, the C corporation. And then the C corporation then will use that money to cash out the 99 shares. So basically it's going to sell that 99 shares. So George is going to sell the 99 shares to that trust. As group one mentioned earlier, there's a trust there. Lenders usually do not allow to give you 100% of the loan anyway. So he is retaining 1 shares in this case. So we have the trust holding the stock itself, and they will sell the stocks to the employees, if you will. And George, in terms, will receive cash from this transactions. So because it's zero basis, and we know that if the when group one, you did the presentation, you mentioned about 25%, right? 25% essentially, that is a capital gain tax, not deferred, but permanently removed from the taxpayers, if you will. So there's approximately about 25% there. And based on the code, group one had mentioned about, there are 3 things in the code. You have to be owning the stock for at least 3 years and has to have at least 30%, owning that 30% of the company. If you transact within 12 months period of time, and you could qualify putting that into a qualified placement property. There are few wealth management firms specializing in offering the qualified replacement properties that they could basically put some stocks together for you. I know Morgan Stanley has something in there that you can look it up as well. What it doesn't qualify in a qualified replacement property is things such as REITs. Think about this as an exchange. If you own a company, you wanted to defer the capital gain, typically has to be an exchange. Therefore, real estate doesn't necessarily qualify. Municipal bond doesn't necessarily qualify. Your own stock of the corporation that just sold is also not qualified for insurance product. So to kind of close out the loop, once you place that into that qualified replacement property, then the shareholders will receive the investment income per se in that case. So from a summary perspective, we know that by selling the 99 shares, getting the loan of $10,000, the owner actually will receive the 10,000. I'm going to move a little bit faster because you kind of know the flow already. So by selling that to the trust, and the owner actually get the cash out pretty easily. So from a tax perspective, if the slide was written before the 21% tax bracket in place, if we were to change in this situation of 21% tax bracket, basically the loan that the company has to pay, so this will change to 21% in the C corporation. I'm giving the $10,000 loan. I want you to calculate, so what is that deduction? So it's not 4 million. I want you to calculate that. So that's one thing to calculate. The second thing that I'd like you to calculate is what is the total savings in this case? What's the total savings? Now, so the first question is to calculate based on 21% of tax bracket, what is sort of a total tax saving. Number two is that if we were to change this to as S corporation, what's the implication for that? Okay, I'm going to break you into the breakout session. So for the purpose of the case study, all we need to do is to calculate if we were to change the tax bracket to 21%, what's the total tax savings? And if we were to change George's company, assuming that it's now as S corporation, what does the tax savings actually looks like? Okay, are we good, everyone, in terms of the questions? Okay, so you should have about, I think about good 3 minutes discussion and then the report back. So I'm going to put everyone into the group breakout room. One moment, please. All right, do we get everybody back? Okay, looks like everyone is back. All right, so which group would like to go first?
I'll go. I'll give you group one.
Okay, go ahead.
So I'll try to replay the questions. The tax savings for the for George would be $2.1 million. So on a $10 million sale, 21% would be 2.1. He effectively gets less of a benefit because corporate tax rates have gone down. So instead of $6 million, in this example, would be 7.9 million, right? So it'd be the 2.1 from the 10 million. And then an example of what his overall savings would be, and we just made a couple of quick assumptions. My joke to the team was this is the Phil Mickelson scenario, right? Where he got a lot of hot water because he said his tax bracket was 60% as a California resident. So let's even call it 50%, right? So at a $10 million sale is $5 million in all-in gains. And so by doing the full ESOP and the qualified replacement property, that's all negated. And so it's a $5 million savings of a tax exposure.
Okay, thank you. Let's go to group 2, please.
Jeff Stein, you want to walk through that?
Sure. Yeah, well, using these calculations here, basically changing from the 40% to 21% tax bracket. So if you didn't do it, there'd be taxes on the $10 million, which would be using 20% federal capital gains is $2 million. So then if he did do the ESOP, he'd end up with basically a $420,000 savings between doing it and not doing it when it comes to the capital gains tax bracket there. So the basically, yeah, so it's 2.5 capital gains tax. Yeah, so it goes down somewhat, of course, because the lower level of corporate taxes, and again, using the 20%, assuming he's in a 20% capital gains tax rate. I didn't include California because yes, that would be another 13.3% plus a 3.8% Medicare surcharge, but hopefully he's in a state like Washington or Tennessee or Texas or Florida or Nevada, is able to avoid that. So anyway, that's the numbers we came up with. Basically, there was a, what do we say? I'd say a 420,000, no, $1.38 million difference between the two.
Correct.
Yeah.
Okay, all right, good. What about S corporation?
And just don't do it as an S corp. I mean,
So group 1, you got tricked. So Jeff, would you explain?
Yeah, so with the S corp, I mean, it's flow through corporation. I mean, there's a lot of other issues involved with that, but primarily you can't do a 1042 exchange with shares of S corporation stock. It's got to be a C corp. So basically, the recommendation to a company is you're going to have to do a change of corporate titling from S corp to C corp, which can have some consequences in and of itself. But in every case, I've worked with that with ESOPs. It still makes sense when you look at the final numbers of taxes, but there's going to be some costs when you're looking at the differences on how the IRS mandates that you calculate the taxes when you switch from an S corp to a C corp. So it's going to take some away from the total benefit, but it's still better than if you just did it with an S corp, and that's primarily because, especially with the 1042 exchange, that avoids the capital gains taxes, and then your ability to leverage those securities with the 1042 exchange could potentially defer all that until the owner's death and deal with it in the estate side.
Right, so keep in mind that the S corporation usually is not recommended, but when you do an S converted to C, chances are your cost basis will increase. Therefore, your potential 1042 capital gain deferral is not going to be as large as compared to if the company initially started as a C corporation. But there are many techniques to do that. That's beyond the purpose of the class here, but I just wanted to make sure that everyone knows, as Jeff mentioned, that S corporation usually is not recommended. Ideally, it will be C corp. But if there is benefits there, you still have to take that into consideration concerning the conversion portion of it, which will increase your cost basis. for that particular corporation. All right, so thank you very much for that. Let's take a look at a second case of a little bit easier in this case. So in this case, client John and Mary, their business is worth about 5 million. They also have a real estate business, which is the main business operates in. So there are two different entities, if you will. So this is the S corporation here. So the S corporation is worth about 5 million. The LLC is worth about 2 million here. So two different entities. Son Jerry is actually the general manager of the S corporation. Daughter Cindy is a physician, not in business at all. But she's the one that has the business brain. He doesn't. So the way that the owner's goals are, they wanted to gift Jerry 2 million in their mind to equalize the gift. That Jerry will get 2 million, Cindy will get 2 million, but Cindy will get the real estate of 2 million. Jerry will get 40% of the business in 2 million. And then Jerry will have to take out the loan, which is 60% or $3 million to buy the owners out at some point. So if you were to use stock gifting, which is what group two had mentioned earlier, what is your recommendation? What is your recommendation? Now, the reason that the owners wanted to gift the daughter $2 million real estate is if the son runs the company down to the ground, she still have real estate. She could do whatever she wants. She could rent it out to somebody else and there's still going to be money coming in for her. So the idea here is kind of, from a concept, is kind of equalized. So I'm gonna put you into the breakout room. I hope that everyone has jotted down the information. The key information here is that Jerry and Cindy each going to give 2 million. If we're going to do a stock gifts, what is your recommendation? Okay, all right, so I'm gonna put everyone into the breakout room for about 3 to 5 minutes or so. Stand by. All right, welcome back. Both groups had some interesting discussions. So who would like to go first?
I don't know.
Our hat in the ring again.
Group two could go first, but what do
Okay.
you guys want to go in on this, or I answered the last one, so I don't want to hog all the time.
Yeah, but you understand this stuff better than most. So that's your burden to wear.
All right, that's what I get for opening my big mouth. All right, that's fine. All right, so anyway, the gift to Jerry is pretty straightforward. You use valuation discounts. It's 40% of the business. Get the valuation discounts, ship that to Jerry. He's now 40% owner of the company. And the parents, John and Mary, still have control over it. They're still running it. They've got the 60%. Cindy with the $2 million, just giving her the $2 million real estate. You could do that, just make it a direct gift, but you're not going to be able to get the valuation discount. So with that, because it's in an LLC, they could basically use the LLC very similar to how an FLP works. I mean, family limited partnerships are not nearly as common these days, specifically because limited liability corporations could really take the place of that. So they could set it up where there's 99 membership shares of the LLC, with one of them being a management share, shift the other 99% to Cindy, the valuation discounts are there, and then just in their estate documents say that our one management share upon our death goes to Cindy, and now she's 100% owner of that property. That's how they can take advantage of the valuation discounts on both sides. The bigger question is with the 60%, $3 million to Jerry to buy out the company. And there's several ways to do that, but something like a skin would be great for Jerry, but that doesn't do anything for Cindy. All right, if the parents die before the term of the note is over, that's money that doesn't go back in the estate. She's boxed out of that. So we're talking about some other things, but we're talking about idiots, and something like an intentionally defective grantor trust could work pretty well to still ensure that that you get the valuation discounts with that, and that somewhat makes Cindy whole. But the thing is that the sale price, the actual loan itself to the idiot, the idiot could be told, hey, we're going to buy life insurance in this, so that the value of that, the original value that was sold to the idiot, comes back to the estate. But Cindy still could get kind of hosed on that, because if there's still a lot of growth in the company, that Jerry doesn't mismanage it into the ground, that the actual value at the parents' death, at John and Mary's death, could have been a lot more than 3 million. Maybe it could have been 7 million or 10 million, and all that growth would not be hers. It wouldn't be, she wouldn't have any right to that. So probably that's something that they would need to look at, getting some life insurance in there that would go to Cindy to sort of equalize what the estate value, or what they would both inherit at the point in time that John and Mary pass away. Anything else? Did I miss anything, guys?
And Jeff, I think you also pointed out the costs of the idiot as being one of the underlying deterrents of that strategy too, right?
Yeah, well, it's not, well, maybe not necessarily be the cost, but if Jerry didn't run the company well and it was losing money, and then no income was being generated in the trust that could pay off the note and pay the life insurance premiums that the agent might own, that it could cause some serious questions. So Jerry's potential lack of management skills could make that agent not as desirable.
Right.
Okay, very good. Thank you, Jeff. Group one, any thoughts? Anything you want to add?
I don't know how to follow that up. That was really impressive.
Jeff won the gold today. All right. So when you think about the case, I wasn't even looking at that complex situation Jeff was describing, but that was perfect. But what I was really looking for is that if you can think beyond that. So you don't have to just use one tool. You could also use, somebody was mentioning that, but I didn't hear anybody report back. Didn't someone answer about the annual exclusion Couldn't that be part of the solution as well? You don't have to use completely 100% in IDGIT. You could do annual exclusion as well at the same time. The reality is for this particular client, this portion of it, it was not actually thinking about as a private annuity at all. This was actually a commercial loan. They basically want the son to wanted to hold him accountable for operating the business, which makes a lot of sense in that situation. And in terms of the discount, so Jeff mentioned about discount. Yes, discount was factored in. And this parents actually has absolutely no debt. There's no debt in the business. So the discount was factored in both of these cases, both of the S Corporation and LLC. In addition to that, they did have a structure in place until Jerry was able to borrow the money to purchase the entity. Both of the children are actually in what they call the non-controlling share. So then the parents still have some saying in terms of how the business is operating and so on and so forth. The unfortunate part of this will take a long time to do it properly. If they actually use the annual exclusion in there, so it does take a good 7 years to get a portion that's free of taxes, and then other portion takes a while to migrate over as well. So it does take a while to get through it. But if it's a long-term goal of the parents, it's worthwhile doing that. Now, Jerry actually is someone who doesn't have a business sense and doesn't necessarily could run a business well. So that's part of the reason that the parents wanted to make sure that they could hold him accountable in terms of the commercial loan. Keep in mind that as you plan for your clients, it doesn't necessarily mean that one method could do it all. You could have multiple solutions with it. And Jeff have also mentioned that you could also leverage life insurance to equalize the gifts. So that's also an important factor to consider when you're working with client on that. All right, with that, I wanted to go through the next week's assignment so everyone is on the same page on that. So you have 2 discussion questions for next week. So this week, great job of answering total of 3 questions and reply to 1. Great jobs here. So this week, we only have 2. You have literature review paper 2. So be sure to revise or include your revised version of the research questions as well as your literature review part 1. For the most part, I did not give you many feedback in the literature review. I think you get the idea of how to write the literature review by now. The only thing that I provide you is probably just formatting issue, such as citing it correctly. If you were to cite it, how should you do that in the very beginning of the sentence? Writing in 3rd person's mode and move your citation down to the reference, down to the reference section instead of including that into your paper. So this week, you're gonna write the second set of the 5 articles that you picked. Some of you in this round has to change articles already because you realize that the article you read doesn't necessarily align with how to answer your questions. So you might run into that again in this week, but hopefully that you'll be able to find a right one for this coming week. Next week, we have 2 presentations as well. Group 1 will do chapter 35, which is a conclusion of all the transfer methods. And then group 2, you will do section 1202. Section 1402 was the one that we went through today. This is for the ESOP of the transfer of the stock. And this has something to do with the deferral, permanently deferral of 25% of the capital gain. Section 1202 is also type of a deferral, but a much better deal compared to section 1402. So group 2, you have a lot on your plate to do that. Next week, we'll also have, I'm gonna stick to about 15 minutes or so of the presentation for each group. So make sure that you time your presentation appropriately. And be sure to ask questions as well. So next week, once you submit your presentation, I'll be able to tell you to present what pages from what pages and then answer the questions. So with that, does anyone have any questions?
Is it 1402 or 1042?
No, 1202. Section
No,
1202.
we're talking about with the ESOP, with the exchange of the S Corp to the other.
No, next week will be 1202. It's not ESOP at all.
Yeah, I know, but you said it was 1402. Is it 1402 or 1042?
1042. Sorry about that.
All right. Making sure, like there's
I'm
something
like,
else I didn't hear
wait,
about.
Did I say that? Yeah, sorry
Right.
about that. Yes, you're correct. Yeah. But next week is 1202. All right, any other questions? And Jeff Stein, if you don't mind to stay a few minutes after the class, so I
Yeah,
can
sure.
answer your questions on the assignment.
Sure.
Can I ask you one question after class as well?
Yeah.
Okay.
You want to ask that openly or just after the class?
Well, I mean, I submitted 10 articles last week, so I can just
Yes, you did.
revise. Yeah.
Yeah, you can just revise from
Okay.
there. Yeah.
Okay.
Mhm. You're like way ahead. So, I'm trying to read as much as possible or as fast as possible.
I had some free time when I was home from the COVID thing at work, so I just tried to get as much done, and I'll start working on revisions.
Don't give your secrets away. I was just thinking about your Superman. All right, if there's no questions, I look forward to your next paper assignment and have fun preparing the next week's presentation. And I look forward to seeing your presentation next week. Thank you guys. And then sign off so then Jeff Stein and I can have a few conversations about the assignment. Thank you, take care.
Thank you.
Thank you, everyone.
Thanks, everybody.
Thank you.